Hey Money Guy family, it's your host Brian Preston, back with Mr. Bo Hansen. We have another question for Ask the Money Guy.
That's right. You guys have financial questions. We've got your financial answers. Use the hashtag #AskTheMoneyGuy on your favorite social, or go to our website, moneyguy.com, and you can ask us a question right there.
It's Brian Preston, the Money Guy.
Brian, today's question actually comes from a listener email. He sent this directly to us. This is from Brad. And he said, if you've paid in and will receive a state or federal pension, how should you invest the rest of the money? How do you factor pensions into your overall portfolio strategy?
Brad, that's a great question. We get this, if it's not that question, it's how do you factor it into your net worth statement. There's all kind of things, because pensions, we're thankful when we have them as an opportunity, but we don't know how they fit into the jigsaw puzzle of your financial life. So first, for those, because I got to tell you, they are going extinct. You don't see as many of them. So I'll explain for my younger listeners is that pensions are these promises of cash flow that you get for the rest of your life. And they have a little bit of a teeth to that guarantee, because we have a federal program called the Pension Benefit Guarantee Corporation that does have some backstops.
Protections.
It's kind of like FDIC insurance for your pension. So it is nice that you have that. So the next thing you're trying to figure out is, well, if I had this guaranteed thing, especially from a government, what does this mean for me? Does this mean does it lower what I need to? Can I be more aggressive? And so here's the way I would answer that. You have to first kind of understand, in relationship to your overall cash flow needs in retirement, how big of a slice of the pie is this pension going to cover? If it covers a large portion of what your cash flow in retirement is going to be, and you have a decent amount of outside assets, by all means, I do think, yes, you can be more aggressive with those outside assets because you have most of your needs covered through the pension.
Said a little differently, you certainly have a capacity to take on more risk. The question is, do you have a tolerance for it, and is that what makes sense for you? But yeah, if you have large outside assets and the pension covers the majority of your living expenses, yeah, you could argue you could have a more aggressive risk profile.
Now, if it's because I'll tell you, I have a little tiny pension from back when I was doing some government work that's going to be, in retirement, it'll be like $400 a month, which, I'm just thankful for it. But that's, by the time with inflation and everything else, it'll probably just cover my streaming bill every month, or my internet bill. I mean, it won't be something, so I'm not going to be able to take into account, that's not going to change my asset allocation that much. So it's a small portion. So the next thing you're probably trying to figure out is, well, what is the pension and how do you account for what's coming from the portfolio? This is a formula that I want everybody to understand. You need to, a big part of retirement planning is figuring out exactly what you need to be happy in retirement from a cash flow perspective. And then you're going to subtract out Social Security. You're going to subtract out your pension. And then that's what the result of that equation is going to tell you what you're counting on from your investment portfolio that you'll need.
And so, again, ultimately, the amount of capacity that you have for risk, as well as your tolerance for risk, will be informed by that. If it's a relatively small percentage that you need from the portfolio to satisfy your living expenses, you're kind of in the driver's seat. You get to pick and choose how aggressive you need to be. If, however, it's a bigger percentage, you might need to be a little more surgical in how you approach the appropriate risk mix in your portfolio.
I want to talk about with pensions, because one of the things that breaks my heart, because they are so rare, that sometimes people don't put a value on what a pension can be for them. So the thing, there's two things that I think are often overlooked with pensions that I wanted to touch on that didn't necessarily fall into Brad's question, but I think this is a great point to talk about, is that if you work at a company that offers pension, or government, if you're in law enforcement, if you're just a government employee, and you work there, it's a 5-year vesting, and you work there for 4 years, please, I tell you, please take into account the value of that pension when you're evaluating that job change. Because nothing broke my heart more when I was working in county government, when I'd see police officers that had worked for a county for 4.5 years, go take another job that maybe paid them $1,000 more a year to $2,000 a year, when they're leaving behind, when they were 4/5 of the way vested on a pension for the rest of their life. That broke my heart. So don't make that rookie type of mistake just because you're not understanding how everything works financially. The second thing is that when you do get close to retirement and you have a pension, you'll start figuring out, well, do I take this as a lump sum? Do I take this as based on my life only, or do I base it off of the survivor, meaning my spouse's life as well? Make sure you don't just make a knee-jerk reaction on that, because a lot of people, I think, underestimate how valuable that decision is on trying to figure out how to do it right, and they end up making some mistakes.
And just for some context, we've seen it where the lump sum was the best decision. We've seen some where the annuitized stream was the best decision. We've seen some where a joint and 100% survivor was the best decision. We've seen some where a single life annuity was the best decision.
Yeah, I can't give you basic. I mean, everyone is a little different because it all depends upon how healthy the company was when they made this decision to give you the option. So you definitely need to measure twice, cut once, so you don't make any mistakes when you're making those decisions with your pension.
This was a great question. If you have a question you'd like for us to address, go out to your favorite social, use the hashtag #AskTheMoneyGuy, or you can go to our website, moneyguy.com, and ask us a question right there. We love answering them, so keep them coming.
Thanks, guys. I'm your host, Brian Preston. Mr. Bo Hansen. Money Guys out.